the United States heading for another absolutely devastating housing crash? Throughout the history of the housing market, there's always a certain limit any home buyer can borrow to finance a mortgage. Generally, with low interest rates, it is possible to take a bigger mortgage, and currently we are experiencing a downturn in interest rates, allowing people to take more debts. This allows them to finance their houses, and this is causing an upsurge of house prices at a higher rate compared to increase in incomes. This has been accelerated by the economic slowdown, which has forced the central banks to slash down interest rates as a way of boosting the slowing economic growth. For example, the U.S. Federal Reserve has already cut down the rates for the first time since the 2008 financial crisis. In the competitive mortgage market, banks can even go to the extent of offering negative interest rates to borrowers, as long as they have an opportunity to make money. It may look illogical for the bank to incentivize you by paying you to borrow money, but it is either they do so or let the debt-driven economy slowly collapse without any form of intervention. Mortgage lenders are always driven by profit, and they will always exploit any profit margin that comes their way. In the near future, it'll not be a surprise that the banks will be paying you to take a mortgage, a scenario where you will ease your current debt by taking more debt. This bubble will be driven by the central bank's ability to constantly print more money. This cheap money flowing into the housing market will continue fueling the rise in housing prices to extreme levels, causing a hyper bubble as we see in the stock market today. The low interest rate may not affect the current returns, but they will greatly affect the future returns, and investors can expect the interest rates to be set as the average return, almost all investment assets, and the interest rates to continue falling. The price of negatively correlated assets like bonds and stocks will rise. This will continue to a point where the interest rates will reach a bottom line and the rate of return in bonds and stocks will start falling. These prevailing conditions in interest rates have caused the investors to seek better returns, even if it means taking more risks. But the downside is that if this trend continues, bubbles may be formed, and this can destabilize the financial system. Institutional investors, like banks, hedge funds, and insurance companies, are out there looking for better returns and potentially taking bigger risks. In the first quarter of 2018, the mortgage balances jumped by $57 billion. According to the Federal Reserve, the housing debt has risen to $8.94 trillion. This is very close to the $9.9 trillion peaks we experienced in the third quarter of 2008 during the global financial crisis. By lowering the interest rates, the Federal Reserve is fueling the increase in house prices, and this will eventually leave the banks and other mortgage lenders stuck with homes and low-yielding loans as the economy slows down. This will exacerbate the decline, thus pushing the economy to a crisis. Experts are predicting a recession because the American bubble is growing bigger as we're experiencing abnormal economic expansion, which has lasted for a few years after the economy has reached its full employment under Trump's administration. Because of this, the country has to remain vigilant of early signs of imbalance whose reversal could trigger the next recession. With the events of the previous economic collapse still fresh in investors' minds and nominal house prices now exceeding their peaks from 2008, the housing market turns out to be one of the most obvious places to look for any signs of overheating. The housing market is still showing all signs of an economic downturn, but the market is fully subsidized by the Federal Reserve. The U.S. government is guaranteeing all mortgages and then buying them up, and this creates an artificial market, this time owned by the Fed rather than Lehman Brothers. Currently, hedge funds and speculators are gobbling up hundreds of thousands of properties being cracked out by home builders. At the same time, the foreclosure process is stalled in some judicial states, while banks still have massive inventories of housing. Some of the major institutions haven't yet got out of the mess they caused during the financial crisis. For example, Bank of America, JP Morgan, Citigroup, and Wells Fargo still in the process of settling a nearly $20 billion tab with homeowners across 489 states. The day of reckoning will come when the Fed will shift from the current trend and begin tightening things again. Now, it's surprising that the Fed admits they have no clear exit strategy, and the Fed might just monetize some of its treasury and mortgage holdings, but will have to sell a lot of both to normalize its monetary stance. The Fed has clarified the fact that they will telegraph this move to the market, but this will be the worst thing, because it will be everyone else front-running the Fed in selling their assets. Remember that during the Great Recession, the stimulus of low interest rates was centered by a tightening of lending standards, as lenders feared rising default risks, and this led to the collapse of the system. Now this time, the interest rates might be lowered, but this will have a limited stimulative effect, since low rates cannot force borrowers to borrow if they are not willing to do so. Currently, the public is already over-leveraged with a mortgage, school debts, credit card debts, and this over-dependence on the debt will magnify any drop in house prices. The trade war is one of the factors which may quicken the race to zero interest rate and possibly a negative rate. If this happens, it'll take years to get back to normal conditions. House prices cannot soar forever. The future generations don't want to be saddled with a house that won't make money and will cost money to keep on top of taxes. To many people, real assets are the only assets that matter, and if you can't touch it, it isn't a real asset. Currently, there are about 25 million excess, empty, and defaulted houses out there, and another 35 million beginning to become empty as boomers die. In this condition, it's going to take a bunch more than investors to prevent the house prices from falling. Very high housing costs, both for sale and rental, have extracted all the discretionary income from budgets. This is causing the collapse of entire industries which are dependent upon this discretionary income. The Fed and complacent politicians are to be blamed because a home is a money pit and not an investment, as the real estate industry insists. In our economy, houses are very overpriced assets, and the high prices are held up with easy-to-acquire mortgages and low interest rates. Additionally, there are many houses held offshore by foreclosure banks. Now, it's expected that as soon as the rates begin rising, the home prices will tumble. Will the Fed then begin buying houses to stabilize the market? A great deal of this housing recovery that's driven the average home price up has been accelerated by the Wall Street hedge funds that are buying the bulk of foreclosed houses with the aim of turning them into rentals. Because of this massive institutional buying, the housing market has been crowded by big businesses. The average American has no place in the housing market. In some parts of the country, cash fleeing China and other countries have flowed into the market, and this has further pushed the prices higher. These circumstances have created a very questionable base to validate higher home prices when we consider the fact that the housing market is driven by the Federal Housing Administration by issuing mortgages even to borrowers that lack substantial collateral. History has proved that this kind of financial stimulus encourages people to buy homes they cannot afford. It should be noted that low interest rates do not always bring prosperity or quality growth. Many years of poor growth, despite low interest rates in Japan, has already proven this. It's also important to note that low interest rates often do not create all that much new debt, but simply moves forward what does exist. To make things worse, the Federal Housing Administration is busy guaranteeing risky mortgages written by thinly capitalized institutions. Back in 2012, Wall Street banks represented over 65% of Federal Administration-backed loans, and today this number is still rising. The increased loaning money to people who can't pay it back is a recipe for disaster, And if things are not tamed, we might see a replay of the 2008 housing crisis. Our politically driven administration has insured subprime mortgages with down payments of as little as 3.5% on top of using weak underwriting standards. We've also seen restrictions being raised to borrowers who previously had foreclosure cases, and these restrictions may be lifted by about 20% when the Fed's Wall Street bubble pops. Some years back, Lee Iacocca, who bought Chrysler back in the days, made it a viable company. Now, Lee said something similar to when you sell all your cars on Monday and you've got nothing to sell for the rest of the week. Low interest rates just one of the factors skewing the housing market. In recent years, we've seen a strong appetite among foreign investors who are interested in investing in the American house market. This has also fueled the long-running bull market. The property market cycle is now reaching its end, and with the rising uncertainties in the global economy and geopolitics, we've seen a trend where foreign investors have sold more U.S. commercial real estate than they've bought for the last 6 years. The general public may see homes, but the housing market has turned out to be bank accounts where the global ultra-rich people hide their money, either as a way of evading taxes or a way of disposing of ill-gotten money. They may sell some to common folks, and with the remaining inventory, they will be gracious enough to rent the properties at top dollar. This is what's been skewing the foreclosure numbers and limiting supply for a while to keep the inflated prices high. No one can really say that we won't experience a rapid symmetrical retracement on the way down. Just because we've seen a 6-year time frame on the way up doesn't necessarily mean there will be a result of a slow 6-year bear market. The same can be said for the equity market. From 2009 up to today, the prices have been rising higher and higher. When the bubble in these markets will burst, it will be like an elevator coming down without any cables holding it, and those who are awaiting a slow correction in the housing market will be up for a big surprise. In the past 2 decades, we've seen multiple bills related to the housing sector being signed, and this has turned houses to be speculative assets. This has made the prices to skyrocket and to catch up. Everyone has taken massive debts. It's come to a point where it's turned to be a bubble, and everyone is complaining that houses have become too expensive, and young people saddled with student loan may have less hope when it comes to buying a home. In conclusion, we have an economic model of fiat money, ineffective economic policies, and infinitive growth. It could be just a short time before we see the 2008 economic crisis as a warm-up. This growth is like someone addicted to opioid. Everything is fine as long as the doses keep coming. This is how the system looks like with and when things will begin falling apart. Many trillions will be pumped to save the financial system. But the question is, who will pay for all this damage? You will.